Professor Namyong Lee's commentary, long. I fear the IMF crisis triggered by Kim Young-sam's misjudgments in 1997 could recur in 2026 due to Lee Jae-myung's policy failures. A foreign exchange crisis begins when the relational ties among stakeholder groups snap. It is not an event that happens simply because dollars run short. It happens because trust collapses first. The government designs fiscal policy and regulation. The Bank of Korea runs monetary policy and FX liquidity operations. Financial institutions transform maturities and currencies to generate profits. Firms earn foreign currency through investment and exports. Households decide consumption based on income and debt, and foreign investors price policy consistency before they price the numbers. When the relationships among these six groups twist at the same time, the exchange rate wobbles first, FX liquidity dries up, and the real economy collapses with a lag. The failure of the Kim Young-sam administration in 1997 lay in breaking the balance of these relationships while refusing to acknowledge the cause of the crisis to the very end. It pushed the speed of financial opening ahead of supervisory capacity, and even as short-term external debt and maturity mismatches accumulated, it chose optimism and excuses over structural reform. A crisis is not a technical problem, but a problem of accountability, and when accountability is scattered, the market treats the entire nation as a single debtor and withdraws credit all at once. A failure the Lee Jae-myung administration could repeat in 2026 is to mistake a change in the form of crisis for a change in its essence. If the government reassures the public by saying reserves are larger, then shakes fiscal, regulatory and FX messages for short-term performance, foreign investors will reach their verdict faster. In a crisis, the most dangerous thing is not the numbers, but the inconsistency of words. And when words wobble, the numbers fall with them. The one rings the alarm first, and the dollar disappears later. The first criterion is the direction and volatility of the exchange rate. In 1997, repeated defences were carried out under the illusion that politics could manage the exchange rate, and the more often the defence was repeated, the more the market learned that the cost of defence had risen. From the moment the exchange rate spikes, it turns into a stress indicator for prices, interest rates and credit. The one-denominated burden of corporate foreign currency debt explodes, and the collateral value of financial institutions is impaired in an instant. The Kim Young-sam administration did not treat the exchange rate as a warning. It treated it as a matter of pride. Exchange rate defense is not a skill of the FX authorities, but the capacity to operate national trust. And back then the government lost time out of fear that acknowledging warning signals would ignite political accountability. The market reached its conclusion first, and that conclusion was invoiced to the public as a national cost. The Lee Jae-myung administration must cut off the temptation to treat the exchange rate like a policy achievement as pressures for one weakness build in the second half of 2025. If every bout of one depreciation is met with tax incentives or hedging by public funds to stage a short-term rebound, the market reads both the willingness to intervene and the underlying vulnerability at the same time. The exchange rate is not stabilized by pressing it down. It is stabilized by policy consistency and structural improvement, and the moment the exchange rate is managed politically, the cost of 2026 rises. FX reserves are not a big number, they are a shield that must activate immediately. The second criterion is the absolute size, composition and usability of FX reserves. At the end of 1997, Korea's FX reserves were around $20.4 billion, but usable reserves in practice were far lower, around $8.9 billion. The gap between the claim that reserves existed and the reality of limited usability shattered trust, and after trust broke, reserves turned from a shield into ammunition that could only be consumed. The Kim Young-sam administration failed to explain the practical effectiveness of reserves honestly to the public and the market, and it failed to demonstrate an operating system that would show in what order and by what instruments dollars would be supplied when short-term debt maturities were concentrated. Under international standards, reserve adequacy is assessed alongside short-term external debt, import payments, and FX liquidity demand from the financial system, but at the time Korea did not make that standard an everyday discipline of national management. As of the end of November 2025, Korea's FX reserves are reported at $430.66 billion, and by the numbers alone, this is not comparable to 1997. Yet the core of 2026 is not size, but wartime operability. Reserve effectiveness depends on how quickly securities-heavy assets can be liquidated in a crisis, how immediately supply windows such as foreign currency loans, FX swaps, and foreign currency repos can operate under legal procedures, and how predictable the fine-tuning principles are for reducing one-sided moves in the FX market. The moment the Lee Jae-myung administration uses reserve size as a political shield, structural vigilance loosens, and when vigilance loosens, the crisis accelerates. Short-term external debt and maturity mismatch were the original sin of 1997 and can be the trap of 2026. The third criterion is short-term external debt and maturity structure. The trigger in 1997 was an asymmetric structure in which short-term debt overwhelmed reserves, and once rollovers broke, financial institutions and firms demanded dollars simultaneously, pushing the entire nation toward the threshold of settlement failure. Korea's net external liabilities were recorded at about $63.8 billion at the end of 1997, leaving the structure fundamentally fragile. The heaviest responsibility of the Kim Young-sam administration was effectively leaving short-term debt discipline unattended. It tolerated short-term borrowing to sustain growth momentum, and supervisors did not conduct continuous stress tests of maturity, gaps across banks and non-bank institutions. Short-term external debt is the money that is reclaimed first in a crisis, and the more it grows, the more anxious the market becomes even when reserves appear ample. If the Lee Jae-myung administration dismisses short-term external debt risk as a story of the past, it becomes a policy failure. Today's weak links may be dispersed and hidden not only in banks, but in non-bank FX funding, overseas alternative investments, derivatives margin calls, and overseas real estate exposures. FX liquidity demand is invisible in normal times, but appears all at once in a crisis, and in that moment it is hard to stop even by raising rates, while cutting rates can make the collapse worse. The government must expand short-term debt and FX liquidity stress testing across all sectors and must not shake supervisory discipline that reduces maturity concentration for political reasons. If you get drunk on surplus, the current account turns and capital leaves. The fourth criterion is the level and quality of the current account. The essence of 1997 was that the ability to earn foreign currency weakened, the speed of borrowing foreign currency increased, and the gap was filled with short-term debt. The more the current account wobbles, the more the FX market demands structural transformation rather than defense. But at the time, the government repeated short-term measures instead of pursuing transformation. The Kim Young-sam administration failed to read in time the cracks in export competitiveness and shifts in external credibility, and it delayed corporate and financial restructuring. When the current account deteriorates, the government's task is not to suppress the exchange rate, but to clean up weak links in productivity, industrial structure, and corporate governance. The cost of postponing that cleanup was an FX cliff. Korea's current account for October 2025 was reported as a surplus of $6.81 billion, and the cumulative surplus from January to October 2025 was presented as $89.58 billion. The numbers do not look bad, but it is dangerous to ignore the quality of the surplus. If chronic service account deficits, surging overseas spending, dependence on specific items and markets, and trade policy risks combine, the surplus can thin rapidly. The moment the Lee Jae-myung administration packages the surplus as a political achievement and piles on more debt, the defensive capacity of 2026 weakens. Finance cracks first in non-banks and real estate not in banks. The fifth criterion is the soundness and liquidity of the financial system. In 1997, what mattered more than the mere existence of bad assets was the fact that liquidity was cut off and those bad assets materialized all at once. If you have capital but no cash, you fail. And if markets freeze, collateral cannot be sold, and then credit destroys credit. The Kim Young-sam administration failed to clean up financial institution weakness early and repeated political patchwork over market discipline. In a crisis, what is needed is disclosure, not concealment, and resolution, not delay. When supervision wobbles, financial institutions chase short-term profits, and those profits become long-term losses transferred to the public in a crisis. The risk in 2026 is likely to erupt first in real estate and the non-bank sector. If tighter lending regulation does not bring prices down, regulation becomes stronger, and as it strengthens, transactions, construction and consumption freeze, undermining tax revenue and the base of growth. At the same time, if credit channels such as corporate bonds, commercial paper and project finance seize up, a liquidity crunch can spill over into banks even if banks appear stable. The Lee Jae-myung administration must not treat real estate politically. It must cut the transmission channels of credit risk technically, and the moment regulation is waived as an achievement, the probability of crisis rises. In a debt-heavy nation, low growth is a crisis amplifier. The sixth criterion is the sustainability of household and corporate debt. The 1997 crisis began in FX markets but ended by burning through people's lives. The record that the 1998 unemployment rate rose to 6.8% and the number of unemployed surged to roughly 1.46 million shows that an FX crisis is ultimately a livelihood crisis. The cost of crisis is paid not on a currency chart but at the family dinner table. The failure of the Kim Young-sam administration was misunderstanding the relationship between debt and growth. Debt should be the result of growth, not the fuel of growth, and if you keep adding fuel without results, the engine breaks. The more foreign currency borrowing accumulates, the more an FX shock turns directly into insolvency. As of the second quarter of 2025, Korea's household debt ratio is presented at 89.7% of GDP. At this level, when potential growth weakens, households and firms have no buffer to absorb interest rate and FX shocks. The Bank of Korea has indicated that potential growth is estimated around 2% over 2024 to 2026. In a low potential growth country, if expansionary fiscal policy and regulatory policy pull in opposite directions, markets price uncertainty first, and that price shows up as the exchange rate and interest rates. The Lee Jae-myung administration must not rely on regulation alone to curb debt. It must raise repayment capacity through productivity reforms, and the notion of buying time with popular stimulus becomes poison in 2026. Predictability in fiscal governance and the rule of law creates credit and destroys it. The seventh criterion is fiscal space and the path of public debt. Fiscal policy was not the direct cause of 1997, but fiscal credibility was essential to bear the costs of restructuring and strengthening the social safety net afterward. What a state must do in a crisis is not to spray money, but to establish order, and that order begins with budget transparency and accountable politics. The Kim Young-sam administration failed to clarify responsibility and burden sharing early in the crisis, and that uncertainty amplified market fear. Markets do not look only at fiscal numbers, they look at whether politics has the resolve to bear the costs. When resolve wobbles, sovereign yields, the exchange rate and inflation worsen together, and real household income breaks first. In 2026, the Lee Jae-myung administration must cut off the temptation to turn the budget into a political cash dispenser. In a situation where indicators suggest the public debt ratio rose to around the high 40% range by mid-2025, repeated fiscal expansion can weaken fiscal credibility, and when credibility weakens, the FX market reacts immediately. The government must account honestly for long-term spending in the National Fiscal Act framework, medium-term fiscal plans, public institution debt management and social insurance programs, and it must operate tax policy predictably. Law and institutions are not tools that swing with the business cycle. They are disciplines that accumulate credit, and the moment the Lee Jae-myung administration shakes that discipline, Korea's risk premium rises. A Korea-US swap line is the final safety pin of FX security. The eighth criterion is the dollar backstop of a Korea-US currency swap. In 1997, Korea effectively lacked an immediately available central bank dollar window in the early phase of the crisis. Markets reach conclusions faster than politics can convene, and when dollars run dry, what is needed is not pride, but a switch. The Kim Young-sam administration viewed FX security as a financial technique and failed to elevate it to a national security-grade mechanism. In the end, Korea signed a 3-year standby arrangement with the IMF on December 3, 1997, and was pushed into a support package of $58 billion involving the IMF, the World Bank, the Asian Development Bank, and major countries. This was not the price of needing external money. It was the price of losing trust. What the Lee Jae-myung administration must understand is that a Korea-US swap line is less a machine to draw dollars and more a psychological safety pin that lowers the probability of panic. The Federal Reserve's standing dollar swap network is designed around core central banks such as Canada, the United Kingdom, Japan, the European Central Bank, and Switzerland, and Korea sits outside that standing network. Korea did sign a temporary $60 billion swap line with the Fed in March 2020 to ease dollar funding stress, and that temporary line ended in late 2021. It is a policy failure if the Lee Jae-myung administration consumes the swap line only as a diplomatic slogan, or if it dismisses it by claiming reserves are large enough. The government must push for dollar backstop Hwagbo as a national security-grade priority, while first reducing domestic FX liquidity risks and policy inconsistency to create a credible case for US consideration, and at the same time integrate alternative channels such as the Fed's FEMA repo facility and the Bank of Korea's multi-country swap portfolio into a wartime operating plan. The Bank of Korea has also indicated that as of end February 2025, the total size of its currency swap agreements with multiple countries amounts to about $148.2 billion, and it must be admitted honestly that these are not a full substitute for a Fed dollar swap. The 10 warning lights we must switch off now will decide 2026. The criteria separating 1997 and 2026 can be summarized into 10: exchange rate volatility, the usability and composition of FX reserves, short-term external debt and maturity structure, the quality of the current account, liquidity and supervisory consistency, non-bank and real estate transmission channels, repayment capacity for household and corporate debt, potential growth and productivity, fiscal space and institutional credibility, and the dollar backstop, including a Korea-US swap line. When these 10 move together, a foreign exchange crisis returns. The Kim Young-sam administration left at least half of these unattended in 1997, and the public paid through unemployment and income collapse. The Lee Jae-myung administration could repeat the same mistakes in different wrapping. If it stages growth rates through expansionary budgets, suppresses prices through stricter regulation, and shakes the exchange rate with public funds to make things look briefly stable, markets will read greater uncertainty and demand a higher price. The goal of policy is not short-term approval, but national credit, and credit is built only by repeatable rules and consistent accountability. The public must stop making excuses as well. An ignorant, incompetent, and greedy mass psychology mistakes debt for normal, short-term support for growth, and exchange rate alarms for someone else's problem. The reason the pain of 1997 repeats is not politics alone, it is also because the public has chosen sweetness without discipline. The path to preventing a second FX crisis in 2026 is clear. Reveal the numbers and institutions honestly, do not delay the resolution of weakness, fix the structure first, secure a dollar backstop at a national security level, and above all, bind policy words and actions into one line to accumulate trust. Only when the people awaken can this country stand upright. Thank you for watching Professor Namyong Lee's commentary, long.